Have you ever considered why we have taxation on income or capital? Or why we have taxes on consumption or production? What about why some entities are required to pay tax, while others are tax exempt? Taking a step back, why does the government take on some responsibilities but leaves others to the market or private enterprise? These are all examples of tax policy. Tax policy is a broad term that captures how the overall tax system should operate and reflects a range of economic, social and political ideals that shape and shift over time. Tax policy is influenced by a multitude of constantly changing environmental variables, including administrative, institutional and political factors. These changing variables require trade-offs to be made, such as between balancing efficiency and growth with distributional outcomes. It also requires acceptance that there may never be an optimal system or solution, even though incremental and sometimes wide-scale improvements can be made to the tax system. So what is tax policy trying to achieve? That can be hard to answer in a succinct way, as there are a range of factors to consider. For example, creating a fair and equitable environment where adequate revenues are raised from a sufficiently wide tax base. Forming an efficient and transparent system that promotes productivity and growth. And enabling a transfer system that protects certain taxpayers while not demotivating or penalising others. But tax policy that exists or works for the current period is unlikely to be relevant for the future. Movements towards the provision of more government services, such as welfare and community infrastructure, and the opening up of economies, such as through free trade and internet commerce, can greatly change the tax policy outlook. More broadly, developments in social, political, environmental, demographic, economic, legal and technological domains contribute to the need for tax reviews. Consider the policy implications for domestic consumption taxes, with the spike in online sales and the importing of low-value goods from overseas. Charging GST on such low-value imports levels the playing field for domestic producers and increases the tax revenue base. But it also significantly increases administration and compliance costs. Other examples include putting a price on carbon, whether through a carbon tax or emissions trading scheme, to deal with environmental concerns and climate change. And enacting new legislation to respond to case law outcomes, such as for the Banford case relating to trust streaming. So tax policy needs to be considering historical outcomes, current trends, and future expected trends. And more, the domestic tax system design must be made within an international context. Tax system reviews are therefore incredibly complex and need to consider a comprehensive amount of information. The reviews often refer to research, statistical modelling, and recommendations from a range of experts and published reports. However, tax policy changes rarely take place at a fast pace. There is typically a time lag between taxation reviews, reform announcements, and legislative change. Plus, not all recommendations end up being accepted or implemented. Recommended changes can be costly to implement and difficult to sell to the electorate. Further, governing political parties change over time, which changes priorities as well as the underlying economic, political and social ideals. For example, Australian tax system reviews in the 1970s led to significant developments in tax policy, taking over a decade to eventually implement, and only after further reviews had been commissioned and published. To recap, tax policy is a broad term that captures how the overall tax system should operate and reflects a range of ideals that shape and shift over time. Because of this, tax reviews are undertaken to identify gaps and failings in the current system and to prepare the tax system for the future.